Ever seen someone online turn a few $100s into thousands through trading? Then another person lose everything in a single week? Ever opened a trading app, looked at all the charts, candles, numbers, and indicators, and instantly felt confused? Most beginners feel exactly the same way. Trading looks like a secret language only finance geniuses understand. People throw around words like leverage, support, resistance, liquidity, options, Forex, crypto, futures, and suddenly it feels less like making money and more like trying to decode the matrix. But here's the truth, almost nobody tells beginners. Trading is actually built on one very simple idea. People are constantly buying and selling things, and traders try to profit from the small movements in price that happen because of that battle. That's it. Today, we're going to break trading down in the simplest way possible so you can finally understand what traders are actually doing, how people make money from tiny price movements, why most beginners fail, and the mindset you truly need if you ever want to survive in this game. So first, what exactly is trading? At its core, trading is simply buying something at one price and trying to sell it later at a better price. That's all trading really is. Imagine you bought a rare pair of sneakers for $100 because you believed demand would increase. A week later, people online start hyping those sneakers up, everybody wants them, and suddenly you sell them for $150. You made a profit because the value increased after you bought it. Traders do the exact same thing, except instead of shoes, they trade assets like stocks, crypto, gold, currencies, or indexes. They're trying to buy when they believe price could go higher, or sometimes even profit when prices fall. But here's where beginners get confused. Most people think traders become rich from giant price movements, like buying Bitcoin at $10,000 and selling at $100,000. But many traders actually make money from very small price changes happening over and over again. Imagine a trader notices a stock moving from $100 to $101. To normal people, that looks meaningless. It only moved $1. But if the trader bought a large position, that tiny movement could still become real money. And when traders repeat this process again and again, those small wins can compound over time. Of course, small movements also mean small mistakes can hurt you too. That's why trading becomes dangerous very quickly when people don't manage risk properly. Now, one thing beginners constantly confuse is trading and investing. They sound similar, but they're actually very different games. Investing is usually long-term. Investors buy companies or assets because they believe they'll grow over many years. They care about the future of the business itself. They're thinking, will this company still dominate 10 years from now? Trading is shorter term. Traders care more about price movement than the actual company. They're asking questions like, could price move higher this afternoon? Or will fear push this market lower tomorrow? Think of it this way. Investors are planting trees and waiting years for them to grow. Traders are trying to predict tomorrow's weather. Neither is automatically better. They're just different approaches. But this leads to a bigger question. What actually moves markets in the first place? Why does price go up or down? The answer is surprisingly simple. Supply and demand. When more people want to buy something than sell it, price usually rises. When more people want to sell than buy, price usually falls. Imagine a concert with only 100 tickets available. If 5,000 people suddenly want those tickets, prices explode higher because demand is greater than supply. Markets work the exact same way, but here's the interesting part. Markets are not only moved by logic, they're moved by human emotions. Fear, greed, panic, excitement, hype, uncertainty. When people become greedy, they rush to buy. When people panic, they rush to sell. That's why charts sometimes look crazy. They're basically human emotions turned into pictures. And contrary to what beginners think, random people on phones usually aren't the ones moving markets the most. The biggest moves are often created by institutions with enormous amounts of money. Banks, hedge funds, investment firms, and billion-dollar funds can buy and sell positions so large they influence entire markets. Retail traders, regular people like us, are usually reacting to moves that larger players helped create. That's why experienced traders spend less time predicting headlines and more time studying behavior. Which brings us to charts and candlesticks. At first, charts look terrifying. Lines everywhere. Red candles, green candles, indicators covering the screen like a spaceship dashboard. But candlesticks are actually simple. A green candle usually means price went up during a certain period of time. A red candle means price went down. That's it. Each candle tells a small story about the battle between buyers and sellers. Imagine a candle as a tiny war report. It shows where the battle started, where price moved, and who won by the end. When buyers dominate, candles often close stronger. When sellers dominate, candles weaken. Once you understand this, charts stop looking random. And this is where trading becomes really interesting. Trading is not really about predicting the future perfectly. It's about pattern recognition. Because humans repeat behavior constantly. Fear repeats, greed repeats, panic repeats, FOMO repeats. And because human emotions repeat, price patterns often repeat too. For example, imagine price falls to the same area 3 different times, but buyers keep stepping in and pushing it back up. To beginners, the chart looks random. To traders, it looks like demand is defending that level. real. Experienced traders aren't seeing magic. They're recognizing repeated behavior. That's why good trading is usually less about intelligence and more about observation. One helpful way to understand trading decisions is something called the IPDE framework. Identify, predict, decide, execute. First, traders identify what's happening in the market. Is price trending upward? Is the market panicking? Is demand getting stronger? Then they predict possible outcomes. Could buyers continue pushing higher? Could sellers take control? Then they decide whether the trade is worth taking. Does the opportunity make sense compared to the risk? And finally, they execute the trade with a clear plan instead of gambling emotionally. This is important because beginners usually skip directly to execution. They click buy first and start hoping afterward. Professional traders do the opposite. They plan first and execute second. So what does a real trade actually look like? Imagine a trader notices Bitcoin falling toward a price level where buyers previously stepped in multiple times before. The trader thinks, if buyers defend this level again, price could bounce higher. Instead of risking everything, the trader enters a small position and places something called a stop loss. This automatically closes the trade if price falls too far against them. Then the trader chooses a target where they'll take profits if the trade works. Now here's the important part. Even if the trader loses this trade, the loss is controlled. This is what separates trading from gambling. Gamblers focus on winning money. Traders focus on managing risk. And this leads to one of the biggest concepts in trading: risk versus reward. Good traders understand they do not need to win every trade to make money overall. Imagine two traders. The first trader wins 90% of the time, but when they lose huge amounts. Eventually, one bad trade destroys months of progress. The second trader only wins 50% of the time, but every time they lose $1, while every winning trade makes $3. Over time, the second trader can actually become far more profitable despite losing many trades. This shocks beginners because most people think trading is about being right all the time. It's not. It's about controlling losses while letting winners grow larger. In fact, many profitable traders only win around 40% to 60% of their trades. That means even professionals lose constantly. The difference is emotional control. Beginners often take one loss and immediately panic. Then they revenge trade trying to win it back, which usually leads to even bigger losses. And honestly, this is one of the biggest reasons most traders fail. Actually, there are three major reasons most beginners lose money. First, they have no risk management. They risk too much money on single trades hoping to get rich fast, and one bad move destroys their account. Second, they trade emotionally. Fear makes them sell too early. Greed makes them stay too long. Anger makes them revenge trade after losses. Third, they treat trading like gambling instead of a skill. They chase random signals, copy influencers, and search for secret indicators instead of actually learning market behavior. The truth is, trading is a skill that takes time to develop. Most beginners expect to make money immediately without understanding how difficult emotional control really is. So what's the correct way to learn trading? Not by buying a fake guru's luxury lifestyle course. The best traders usually learn slowly. They study price behavior, practice with demo accounts, journal their trades, focus on one strategy instead of chasing hundreds, and learn risk management before trying to make huge profits. Most importantly, they survive long enough to improve, because survival is everything in trading. You cannot become skilled if you destroy your account in the first month trying to get rich overnight. And finally, this brings us to the most important part of trading: mindset. Most people think trading is about charts, but trading is really about psychology. Can you stay calm during losses? Can you avoid greed after wins? Can you follow a plan instead of emotions? Can you stay patient when nothing is happening? Because the market constantly tests your emotions. That's why trading is not really a battle against the market. It's a battle against yourself. The people who survive long-term are usually not the smartest people in the room. They're the people who stay disciplined, protect their downside, control their emotions, and think in probabilities instead of fantasies. So if you remember one thing from this video, remember this: trading is not a magic money machine. It's a skill based on risk, psychology, patience, and pattern recognition. The goal is not to win every trade. The goal is to survive, improve, and make smart decisions consistently over time. Because in the end, successful trading is less about predicting the future and more about controlling yourself when the future becomes uncertain. If you think trading changed the way you see money, wait until you realize what money actually is. Most people spend their entire lives chasing it without ever understanding the game behind it. Watch this next. If want how money actually works,